As folks are making their way into the webinar, we will just start off with a few kind of housekeeping notes. First, welcome. We're really excited to have you here today for this conversation, and we're very excited also to have our guest speakers, Anne and Karen. Anne from Silicon Valley Bank and Karen from the National Equity Fund. Thank you both so much for joining us to share more about the fantastic work you all have partnered on and are doing out in California. The topic of today's webinar is leveraging opportunity zones to create affordable housing. And I couldn't think of two better speakers to tell us how they are doing it for their projects. I'm also joined by Rachel Riley of Aces and Archers, who will moderate this conversation, and I'll turn it over to her in just a little bit. We are recording this webinar, and we will share the recording and slides and a recap of the conversation on our website and with all attendees shortly after the broadcast. All right, Amelia, you can go to the next slide. I think that's, actually one more before we dive into the agenda. If you do have any questions at any point in the webinar, please feel free to share them in the Q&A box. We'll be monitoring them, those questions that you submit throughout the webinar, and we will have some time at the end, hopefully, for Q&A, and we'll get to those questions. So yeah, as I said, use the Q&A box, please. The chat box is a little hard to make sure we're catching everything, so the Q&A box is a little bit easier for us to navigate. So in terms of today's agenda, so we'll go through some opportunity zones, updates, and resources, and I'll start with that. Then we'll talk a little bit more about how opportunity zones are a financing tool to expand affordable and workforce housing and what we're seeing more broadly in the market. And then finally, we'll talk about how about leveraging opportunity zones equity alongside the low-income housing tax credit program, and some of the strategies that were deployed by Karen and Anne in their partnership. Go to the next slide. Great. So from an updates and resources standpoint, so I wanted to alert the group, and Rachel will be kind of sharing links in the chat. Corresponding with each of these items, the JTC Americas and Opportunity DB partnered up to issue a survey of 145 opportunity zone stakeholders. They released that report, I believe, last month, and hosted a webinar on that called Getting Impact Right, a New Strategy for Opportunity Zones. I believe that the report name as well. I took a look at the report ahead of time and wanted to just share a few highlights from it, but definitely encourage you to download it. It is free to download to see the key takeaways. 59% of survey respondents had positive views, and these were from current and past investors. So they interviewed current and past investors as well as aspirational investors. I think that was an interesting kind of breakdown. So 59% of current and past investors had a positive view of opportunity zones. Aspirational investors cited community impact as the most persuasive reason to invest in opportunity zones above the kind of rate of return or return on investment. 74% of survey respondents believed OZs are equally advantageous for both communities and investors. And finally, 54% of investors would accept a lower return if investing in a high impact project. That's what they said in their responses. So just a sampling of some of the data collected through that effort, but wanted to whet your palate, so to speak, and encourage you to take a look at that report for more details. From a local updates in Maryland, they continue to kind of lead the way on innovative local policy that helps support opportunity zones. In Montgomery County, the council there approved the BioHealth Opportunity Zone Incentive Program that provides a $250,000 grant to any BioHealth campus developing in an opportunity zone in hopes of continuing to kind of solidify their leadership in that county as a biohealth kind of industry mecca, essentially, or leader there. In California, the Fresno City Council approved an expansion of fee waivers for housing development projects located in the city's infill opportunity zones, bus rapid transit corridors, and the downtown planning area. So again, a couple of examples of how local policy can be overlaid with opportunity zones to kind of help direct the project capital or capital into projects that kind of meet economic development goals set out, by those local jurisdictions. And then finally, I'll call attention to our latest Opportunity Zones webinar recap. Last month, we had a conversation with Mike Novogradic of Novogradic and Company on their latest report, kind of on all the numbers of the market from the survey they conduct through the end of last year. So we had a great conversation on just sort of a general Opportunity Zones market update as of, or kind of through, early Q1 of this year. So I think with that, I will turn it over to Rachel for the next part of the agenda.
Yeah, thank you so much, Catherine. And, for folks that know me, my background is in affordable housing. I spent the majority of my career at a nonprofit that focused on affordable housing. And so being able to tell the story of how Opportunity Zone financing is being used in conjunction with the creation of affordable housing is obviously just a passion of mine. And so I'm thrilled for the discussion today. For folks that joined our last webinar with Michael Novogradic, he provided high-level information from the opportunity funds that they survey on a regular basis. This report really covered through the end of 2021. And one of the key findings is that at least $5.9 billion in Opportunity Zones equity has been invested in affordable and workforce housing as of the end of 2021. And again, I think we should consider 5.9 billion a minimum, so at least 5.9 billion, just given the fact that the survey does not cover all OZ investment activity, just a segment of the marketplace. So I found that encouraging. I think we can always do better and invest more in affordable and workforce housing, which is the reason why we are having this conversation today, to encourage that activity. So we can go to the next slide. If folks are interested in learning more about some of the affordable and workforce housing that has been funded to date, just a reminder that EIG keeps up to date a Opportunity Zones activity map, and you can filter specifically for this. This is a screenshot of the filter applied when looking for affordable or workforce housing. So you can see a number of projects. And again, this is not comprehensive of all market activity. It's just select projects EIG has chosen to highlight through the activity map, but still plenty of activity. One of my favorite conversations to have is after someone asks, what do you mean by affordable? What do you mean by workforce? Those terms can be subjective depending on the types of programs you're working with or the area in which these developments are located. But for the purpose of this conversation, we're gonna be sticking to what I would say are generally accepted terms. So workforce housing, you create workforce housing, there are no subsidies tied to the creation of workforce housing, as opposed to affordable housing, which has a number of subsidies applied to it. And they're typically not income restricted, which means there's no LURA, so a land use restriction agreement around the incomes that housing must serve. It's really mission oriented on the behalf of the investor and typically aligns with local priorities, and there may be some local subsidy tied to it, but no dedicated programs necessarily. And then workforce housing does a great job of filling what we call like the missing middle. So folks familiar with the low-income housing tax credit program know that it only goes up to a certain area median income, but even if you're 1% over that threshold or 2% over that threshold, that doesn't mean that you don't need an affordable place to live. And so not only does it expand the housing stock locally, which frees up opportunities and options for living, It also helps to serve and make affordable homes for folks that are just over that threshold for qualifying for low-income housing. And then it typically targets households earning up to 120% of area median income. And so I would say it's 61% to 120% or 80% to 120%. That's what we mean by workforce housing. Think, your teachers, your firefighters, your police officers. That's typically the types of households or families that are served by this type of housing. And then affordable housing, again, has a number of different definitions tied to it, but it typically means rental units that are income restricted. And the restriction is tied to the source of financing that is used, or multiple sources of financing used to create or redevelop those homes. If you're using the low-income housing tax credit program, the typical cap is 60% of area median income. Karen and Ann are going to have to let me know if it's also the case that sometimes it can go up to 80, but it's typically 60% of area median income. And it can be developed alongside non-restricted homes. So we would call that mixed income housing. So, you could have a certain percentage of affordable units or income restricted units, and then the other percentage of that building could be non-restricted units, so market rate or workforce housing. And our favorite program for affordable housing, low-income housing tax credits, the most prominent. It helps to produce the most units annually. And we'll talk a little bit more about that in a moment. All right. So I just wanted to provide some examples before we dive in deep on the partnership between NEF and Silicon Valley Bank. I just wanted to provide some examples of other projects that have been done both in the workforce and affordable categories. I think it's really interesting that these projects also span rental and for sale homes. And so this first example in Bozeman, Montana, this Bozeman has a limited housing stock. They were facing affordability challenges. And so Catalyst Opportunity Fund went in and made a $6 million investment to develop this project. And they targeted those units at 66% of AMI. So for families that need affordable living options, but wouldn't qualify for LIHTC financed affordable housing in this case. In Flagstaff, Arizona, we saw a $1 million opportunity fund do new starts outside of Flagstaff called Kachina Village. That was the project name. And part of that development was to create affordable homes for sale and rental. The for sale homes were capped at $290,000 and the rental homes were capped at around $1,600 per month. We can go to the next slide. In Cary, North Carolina, this is a relatively new story. Avanth Capital acquired its first affordable housing project through its Opportunity Fund investment strategy. They're partnering with a local firm called Laurel Street to redevelop the apartments. They are keeping these apartments affordable. They're just doing the necessary improvements to ensure that residents have safe, affordable place to live. And they're also adding some new amenities to the overall property. So this is that, garden style apartment complex where, you can do the substantial improvement and also include new amenities in order to meet that substantial improvement test. This is a good example of that at work. And then in Indianapolis, Indiana, there's a 61 unit affordable housing community that's being developed, targeting 30 to 80% of area median income. So, being able to dip down into 30% of area median income is a very laudable goal. It's difficult to do in some cases. It just depends on what additional subsidies you may have to do it. But the units range from 461 to a little bit over $1,000 per month. And 25% of the units are set aside for veterans. And so it is mission oriented in that way, that they are serving a certain population and dedicating a certain number of these homes to serve veterans. And then for folks that may remember, we did probably just over a year ago a webinar talking about how you mix or twin or blend opportunity zone financing with the different tax credit programs. We had a representative from the model group come on to talk about a project called the Wolkomen in Cincinnati. And this is, I still kind of chuckle because it's one of the most complicated capital stacks or transactions I've ever seen. And it blends LIHTC, historic tax credits, new market tax credits, opportunity zone financing, some TIF money, in addition to just traditional debt and equity, in order to complete these 4 transactions on a scattered site redevelopment effort in downtown Cincinnati. We just wanted to lay this out to show you how it's done kind of at a high level, and also show the different transaction parties that participated across the deal. You'll see National Equity Fund, NEF, one of our guest speakers today worked on that deal. And I don't know, I wouldn't say war scars or war wounds, but I think we laugh sometimes just about closing this transaction and just how much it took to get there. So, you know, I mentioned LIHTC earlier. I just showed the Wolkomen, which has low-income housing tax credit financing included in it. We're going to talk a lot about LIHTC during this next presentation. So just in case folks aren't familiar with the program or needed a primer on it, low-income housing tax credit program, also known as LIHTC or the housing credit. It's an indirect federal subsidy used to finance construction and rehabilitation of these income restricted rental properties. And what it does is it gives investors a dollar for dollar reduction in their federal tax liability. And the investors provide equity to these projects, and that equity helps to subsidize the units so that they are affordable. The units have to remain affordable for a minimum of 15 years. A lot of properties have affordability covenants that last well beyond that, just because of the other sources of financing that may be included in those projects. And then the other really important thing to know about LIHTC is that there's 2 subsets of LIHTC. There's the 9% credit, which effectively subsidizes about 70% of the cost of these eligible affordable units. And then the 4% LIHTC, which effectively subsidizes 30% of those costs. And so, you know, you get a bigger bang for your buck with the 9%. However, those are competitively allocated. The 4% credits are typically allocated alongside bond financing and used for redevelopment. 9% is typically used for new construction. There is one caveat. There are 4% that are allocated competitively, but I'll leave it there for everyone. It's too much information about LIHTC, and I'll turn it over to our wonderful guest speakers from NEF and Silicon Valley Bank to talk about the really encouraging work that they've done in California to structure a $110 million opportunity fund that leverages LIHTC to deliver affordable housing in California.
Right. Thank you, Rachel and Catherine, and really glad to be here with Anne to talk about how we've been looking at opportunity zones and how it can help to create more affordable housing. So I first wanted to, next slide, first wanted to give you just a short overview about National Equity Fund. We are on our 35th anniversary this year. So we were established really, we are a nonprofit, and we are a subsidiary of Local Initiative Support Corporation, which is a national nonprofit intermediary. But we were really established to help with the financing of affordable housing and have really become one of the largest syndicators of the low-income housing tax credit, having, since we started, done about 3,000 affordable housing developments and have invested over 20 billion in tax credits since our inception with multiple different investors. I think one thing I wanted to point out is we have now just started working with the Opportunity Zone program. So we now have 113 million in OZ investments, which is small compared to what we have done in tax credits, but 595 OZ units under management. And that's currently investments in 8 different properties and 2 opportunity zones, hopefully soon to be 9 properties once we close on our last investment with Silicon Valley Bank. So you can go to the next slide, which is why would NEF, who just really is focused on the tax credit program, be interested in using opportunity zones? And I just wanted to briefly just state that initially, I think our thought was really this opportunity zone program is another tax program that we saw as a way to help to attract new investors to affordable housing. A majority of our investors, like Silicon Valley Bank, are financial institutions that are in the program and really doing great work and meeting Community Reinvestment Act obligations. But we thought maybe there's a way to bring in other investors, non-banks, that may be interested in affordable housing. Most of our bank investors, unlike Silicon Valley Bank, do not have large capital gains to invest. And then we initially also wanted to really focus on workforce housing as kind of an adjunct to what we do on the low-income housing tax credit side, so that we could help our current partners, developers, do that next stage housing, so that that 80 to 100% AMI range is really where we were focused. In addition, we were glad to also work with twinning those benefits with tax credits where that made sense for our partners. So one thing on our workforce housing program, just briefly, is that we have found that non-bank investors, it has been really difficult to attract for what we are trying to do as workforce housing. So as Rachel talked about, it can be defined as 80 to 120% of AMI. I think we have really tried to think about it as being that 80 to 100% AMI as a way to really work in these communities and as a way to, again, provide next step stage housing for people who were kind of in tax credit housing. However, to do that, we are not providing the returns that non-bank investors would like, or that we're seeing really investments in opportunity zone workforce housing currently at, which would probably be the mid-teens. Ours would be at, much lower than that. So we though are continuing to work in the space, continuing to try to find investors that may be doing this. And I think that eventually we'll find that pairing. OZs is a new program altogether, so it's difficult to get investors to understand both affordable housing and the returns that it takes to make affordable housing, I think, work, especially for what NEF wants to achieve. Next slide. So our experience, as I said, with opportunity zones is we've currently have invested in 4 workforce housing investments. 2 are in North Carolina, our new construction, and 2 are historic rehabs, which was what we worked on with the model group. 1 project was paired with new markets and 1 with historic credits. And we have done 5 tax credit investments to date that were twinned with the opportunity zone benefits. Some of that was with Fifth Third Bank, who I think some of you have met before on a previous EIG meeting. So general feedback, twinning affordable housing programs, new markets, low income, and even using historic program with OZ is not always easy. There's a lot of different rules and things that you have to think about. So having good tax partners has been extremely important for us. The other is that the one good thing I think is that this OZ program has provided additional dollars to our investor partners that want to do affordable housing, that they, it's a new source of capital. And I think, as Anne will talk about, it gave them an ability to really have a larger proprietary fund. And I know it gave Fifth Third Bank an opportunity to also have new dollars that they might not have had before. So that's been a really positive thing. Some other general feedback is that on doing these locations and timing are important factors. So when you think about the low-income housing tax credit program, as Rachel said, it's extremely competitive. Properties are allocated credits by the states, and it's an extremely competitive program. So trying to match up in some cases when an investor has capital gains, and then whether at that point in time we have projects which have been allocated credits or about to be allocated credits that also happen to be in opportunity zones. That's one thing that is an issue to think about. And then also that tax credit deals from the time that they're allocated to when they're closing can be somewhere up to 6 to 9 months. Excuse the phone in the background, I'm unable to turn it off. So anyway, those are just things that all have to be thought about. And then on workforce housing, what I think I've really learned in doing a lot of this is that workforce housing deals and opportunity zones are really best in expanding markets with lower construction costs. North Carolina, Texas work well. Trying to do it in Chicago with high construction costs has been really difficult to make work, though we will continue to try. And having committed local partners that really want to work with you to provide workforce housing, the cities, counties is also, I think, really helpful to make these work. So the next slide talks about NEF in Silicon Valley. So we have partnered with Silicon Valley on 4 prior proprietary funds, and they have been a long-term investor in our multi-investor California equity funds, all which invest in tax credit properties in California. So because we had prior success in laying out and working through the tax credit and OZ pairing and had really thought about how this would work and what are the guidelines for doing that. When I think Silicon Valley Bank, having worked with us, knew that we were doing this, it seemed to be a good opportunity for us to chat and talk about whether we could help them with their capital gains dollars. So I think that gave us some really good confidence in working with us. And we also have been working, I'm going to say, with Applegate, Thorne Thompson, Holland and Knight, both extremely helpful in terms of us structuring our deals and also helping us work with Silicon Valley Bank's in-house tax group to help them understand how this would work for them and what those issues are. There's a lot of things to think about in pulling all this together besides just the investments in the real estate. So all those factors, I think, were what kind of brought Silicon Valley Bank and NEF together to help to create this large OZ fund that really was just focused on low-income housing tax credit deals. And I'll let Ann talk a little bit more about Silicon Valley Bank and how this came together from their perspective.
Sure. Thank you, Karen. So a little bit of background about Silicon Valley Bank. We're a little bit unique. We were founded in 1983 with a real goal to address what was felt to be kind of a missing a segment in the economy that was not being addressed, the innovation economy. So on this slide, on the left-hand side, you see the sectors we serve. We serve hardware, software, life sciences, fintech, climate technology, as well as investors and premium wine. And on the right-hand side of the slide, you can see the stages of clients, from early stage startups all the way to corporate publicly traded clients, as well as investors and individuals. And you can see that we do take a fairly substantial market share of the innovation economy. Next slide, please. So lending to early stage companies is risky, and our risk is offset by taking warrants, although these warrant gains are not guaranteed and most are not significant. However, in fiscal year 2021, it was an exceptional year for the bank. We reported $560 million in warrant gains, which again was an exceptional year. And we don't anticipate future gains to be, although healthy, not quite this high, probably a little bit more volatile. We had initially explored the ozone program in 2018 with NEF, but we did not really have the capacity to move forward. It was a new program. However, in 2021, given our really substantial gains and the fact that this was the last year to maximize its benefits, we were incentivized to move forward. So 2021 was the last year to take advantage of the 10% capital gains tax reduction, since it's no longer applicable as of 2022. You might have noticed in the prior slide, Silicon Valley Bank has no traditional commercial real estate group. However, we do invest in and we lend to affordable low-income housing tax credit projects, LIHTC projects, as one aspect of our Community Reinvestment Act strategic plan. So twinning the ozone program to take advantage of our capital gains, as well as with LIHTC, was the best option for us through our long-term syndicator partner, NEF, who we had explored the program with them previously, and we knew they were very knowledgeable. Silicon Valley Bank is also providing construction debt to the lower tier ozone projects. Next slide, please. So we identified a one-time $110 million capital gain to be used for the program, which involved buy-in from our internal tax, accounting, and regulatory departments. There's multi-pronged benefits from this investment, two types of CRA credits, since we are providing $103 million in community development loans, construction loans, as well as the $110 million LIHTC investment. There's two types of federal tax benefits. The first benefit being from the low-income housing tax credits, as well as the capital gains tax 10% reduction and the 5-year tax deferral. There's also substantial community benefits. And our bank is community benefits are very important to us. So we developed 345 affordable housing units for low-income individuals and families, including units set aside for farm workers, as well as supportive housing for formerly homeless. Next slide, please. There is a very strict timeline that I will let Karen correct me if I say this wrong, but within 180 days of identifying the capital gains, they need to be deployed into an ozone fund. So we identified $110 million capital gains in mid-February 2021, and then the hunt was on to find projects that NEF was very good in helping us do, because they have a lot, they know a lot of the lower tier sponsors, as do we, and they know our mindset that we really want to do impactful housing. So by June 2021, we had identified 4 projects, and the underwriting began. The fund closed and was fully capitalized in early August 2021, so we met our 180-day timeframe. 3 of the projects have already closed into the fund. The 4th one is projected to close later this month, and 90% of the ozone funds must be fully allocated to the project by June of 2022. Did I get it right, Karen? Next slide, please.
All right. Yeah. So yeah, Anne, you got the timeline right. And I think that for us, I know establishing that fund and getting that $110 million in, we really all wanted to know we had projects that could meet the timeline. And so we looked at other projects, I believe, too, Anne, that, right, that weren't going to be able to close in time, or which we felt that, there was just too much risk for meeting that 90% test.
Yeah, I forgot about that. It was really not easy finding these projects.
Right. And I think we were lucky when you decided to do this, that also the state had just started allocating credits to projects. So there was a lot of different things that were available. And as we'll see later, we were lucky to find ones that were also just right in the OZ boundaries.
Barely.
So I wanted to just kind of talk about, what are the benefits of pairing opportunity zones and tax credits? And besides the benefits that Anne has been talking about to the bank, which that they had the capital gains tax, they're able to defer and reduce it. And that's a big deal, I think, to the bank and their tax group. And then we have heard in the past, I think when the program first came out, there was kind of a thought that, gosh, if you could pair and twin opportunity zones and tax credits, it would be a huge benefit to the financial institution, and also potentially a really nice bump in pricing to the deal. However, as the program rules were refined and finished up, the things that people thought could maybe work to make that happen just were not allowed under the final code. So when we really look at it, on doing these deals for the tax credit investor, there's really not, there's a very modest increase to the return. And I think the reasons for that, so there's a slight increase, which is good because there's some difficulties in this program. It's nice to have that kind of a slightly additional return. But when you think about it, the reasons why there's not a higher return is that on OZ funds, all your investment dollars have to be deposited into the fund in day one. So here it was in August of 2021. On a typical tax credit fund, Silicon Valley Bank would be putting their money into the fund over like a 5 to 7 year period. So as deals are completed and meet certain benchmarks, and then reserves, of course, get paid in even later. So that's one big thing that really pushes back your return. The other is that a big piece on OZ deals is the fact that you have no capital gains on the appreciated value at sale. However, on tax credit deals, especially the ones that NEF and Silicon Valley Bank were really focused on, which are highly supportive deals, very targeted, there's limited to no appreciation. And in California, there's a 55-year LURA, which means that these projects have to remain affordable for the long term. So even after the 15-year low-income housing tax credit compliance period, when Silicon Valley Bank exits and NEF exits, these projects have to remain affordable. So there's really no gain on the sale. And so that whole idea of the elimination of the capital gains tax at sale is not the benefit here. One slight benefit is that on a 4% bond deal, there are often a lot of losses that are taken that create an exit tax issue for the developer and for the investor. And on the OZ program, our attorneys had determined that, that is one benefit, that the long-term investor would not have that exit tax would not be applicable. So that was one benefit in terms of some of the structurings on the bond deal. For the developers, from our perspective too, it was like there's a lot of additional hoops they have to think about. We have to structure this a little bit differently. There's a lot more reps and warranties for them about opportunity zone regulations, because we have to all make sure that all these properties remain as qualified opportunity zone businesses. This is extremely important all around. And there's, as you guys all on this call know, there's a lot of tests around that. So from the developer's perspective, there's some additional reporting, maybe a little bit additional work that their accountant has to do. So why would they want to work with someone who has an opportunity zone fund on this program when there's lots of other investment dollars out? And maybe the increase in the amount of credit payments that we're making is not that high. But really, I think what we were able to show, and I think people really appreciated this, was because of the fact that so much of our investment dollars had to come in upfront into the project, we were able to use those to help to pay for construction costs, reduce the construction loan down, and Silicon Valley Bank still was in for the construction loan. But because of that, there was a decrease in construction loan interest. And that really allowed for a higher paid developer fee, less developer fee that was deferred and have to be paid out of cash flow. So I think a lot of developers really saw that as a benefit, especially in California. And whereas normally in California, equity on a tax credit deal comes in very little upfront, most of it not really all pushed back till stabilization. So this was a big change in how they could receive the dollars. And in some cases, we might have even paid slightly less on the price, but the overall benefit was to them of, less costs over on the deal to a slight extent was really a good benefit. Ann, anything else you want to add on that?
Nope, I think you covered it.
All right. So then the challenges. And so I think what was interesting to me, because we had done some tax credit deals in the Midwest, looking at the California market, what was interesting is projects there often take a long time to complete. 24 to 36 months is not an unusual period of time. And part of that too is just getting through the completion. These are larger deals. I think they're new construction, and getting to the conversion can take a little bit longer just because all these projects have multiple sources of financing. It's not just, debt and equity. There's a whole bunch of soft money that really makes this work. So what we really were challenged with is the fact that, gosh, we've got to put all of our money into these projects, into the working capital account, and then those have to be expended for project costs within 30 months. And we looked at the fact that some of these deals were going to take longer to complete. So we had to really think about how we funded the money from the fund into the projects, and our 90% rule that we had to meet by June of this year. So we were able to structure this so we put money in up front and then another huge slug of money into the projects in June. So we have 2 consecutive 30-month working capital periods on almost every one of these deals. That really did make that work. And then we also were able to hold back some money for developer fees. That still was just that 10% of the total amount of the fund that was held up. So we expect that we will have no issues meeting our 90% test in June. The other thing that was somewhat of a challenge, I think, is the related party rules. And mainly because we work with related party rules a lot in the low-income housing tax credit platform, but there is a 50% test, and under the OZ program it's a 20% test. So it's very typical to have, one of the developers providing land or as a related party contractor. And so we really had to follow that a lot more closely. I think in California, what's helpful is that the related parties having to take only 1% of cash flow and sales proceeds was not something difficult. The deals we're looking at don't have much cash flow or expected sales proceeds. So it was actually not a difficult conversation to have to make that work and meet our tests. The last thing was the non-qualified funds. A lot of these deals, because they're supportive housing, have very large reserves. So we were kind of looking at the fact that we were really close to meeting the cap on that. A lot of it was because the state was requiring really large reserves for services or subsidy. And the more we looked into it, we realized that working with our tax partners, that a lot of these reserves were, while they were held at the project level, were really controlled by the state and were there in order to get that state funding. So therefore, we were able to basically remove them from that calculation of the NQFP so that we could make sure we could meet that on an ongoing basis. The next slide, please. So those were, I think, some of our main things, and having our tax partners, again, was extremely helpful. A lot of thought went into that. We worked with Silicon Valley Bank, had a really good grid on underwriting and meeting all the OZ tests. So we were able to get the last deal. I think we'll get to closing coming up soon. I think hopefully in the next month. So I let Anne kind of go through the projects that were chosen, just to give you a sense about what those are.
Sure. So there are 4 projects that you see here. Caritas Homes with Burbank Housing, 425 Aussie Ray, I believe is Eden Housing, 803 East 5th Street. Aussie Ray is in, I believe, I don't remember the location of all these. I remember Caritas.
And the next slide.
Yeah, let's go to the next slide. Okay, so this slide, you can see it's quite a challenge to find projects. Finding the LIHTC projects, that was fairly straightforward, but finding projects that were both LIHTC and within O-zones was indeed a challenge. As you can see from this map, some of these are like right on the edge of O-zones. I think one of them is actually within a block of not being in an O-zone. It's like in the last block. So next slide, please. Okay, this is my cheat sheet. So 425 Aussie Ray is in San Jose with Eden Housing, a nonprofit that we've done a lot of deals with. 130 units from 30% to 60% AMI. As you can see, 64 permanent supportive housing units for formerly homeless, which is supported by rental subsidy, using 4% credits. All kinds of really nice amenities for the tenants. A total investment of 82.3 million, which includes 37.4 million of LIHTC equity, as well as almost 45 million in construction debt. Caritas Homes is with a partner that we've been looking to partner with for a long time, Burbank Housing. I believe our wine group actually contributed. They contributed a little bit to this project as well. It's located in Santa Rosa, Sonoma County, within the wine country location in California. 64 units, again, including some units for homeless families supported by rental subsidy with using 9% credits. Total investment of 37.4 million, including 22.1 million in LIHTC equity and 15.3 million in construction debt. 803 East 5th Street is in Los Angeles with Coalition for Responsible Community Development. This was actually a new relationship for Silicon Valley Bank, but a client of NEF. We had been looking to expand in Southern California, so this was very helpful. It's located in Los Angeles, California. 95 units of permanent supportive housing for formerly homeless at 20% AMI, again supported by rental subsidy with 4% credits. This one's a little bit different. It's an adaptive reuse of an existing building, again with lots of nice amenities for the tenants, and total investment of 47.3 million, including 19.3 million in LIHTC equity and 28 million in construction debt. Coachella Valley, this is the one that we'll be closing later this month or early next month. 56 units for families and farm workers at 30 to 60% AMI, including 26 units supported by USDA subsidies using 9% credits. Total SVB investment of 33.2 million, and which includes 23 million in LIHTC equity and 10.2 million in construction debt. So that's it. At this point, I guess, do we open it up for questions?
Yes, there are a lot of questions. I have a lot of questions. So we have about 15 minutes, just a little bit less than 15 minutes to go through it. I just want to say this portfolio that you guys have funded is just exemplary, right? It is a really great use case of how you reach deep on AMI. So, having a project that's 100% dedicated to AMIs at 20%. I know we're going to say a lot of percentages and inside speak on this, but being able to reach 20% of AMI households, 30% of AMI households, it's really fantastic. And one of the things I noticed is that you guys use both 4% LIHTC and 9% LIHTC. So I think it demonstrates that you don't have to stick with a 9% strategy or a 4% strategy. OZ Equity can work alongside both subsets of the low-income housing tax credit. And I also thought it was great how each project had at least, half or right around half, if not more, of the units set aside for a certain type of population, whether it be for formerly homeless households or for farm workers, but whatever was needed in that community, these projects are helping to fulfill that need and provide affordable living for those folks. So one question that we did get was just a clarification around this term, permanently supportive housing. And I think your presentation showed that these projects included or were permanently supportive housing, permanent supportive housing. Can you guys just define that for us? Like, if you're not, working in the affordable housing industry, this term PSH or permanent supportive housing may not be familiar to you.
Well, I'll start and I'll let Karen jump in. But it comes with typically permanent supportive housing. It requires a level of services for formerly homeless or people at risk of homelessness. There has to be subsidies because they can afford such minimal amount of rent, with a goal to ultimately sort of transition them out of the permanent supportive housing. They might need the permanent supportive services for a couple of a few years to get on their feet, but a goal to ultimately get them on their feet so they could still they might still live in a subsidized unit, but they might not need all those supportive services that come with permanent supportive housing, which could include mental health issues, addiction issues, financial education, a lot of different kinds of supportive services. And I'll let Karen jump in if she has anything to add.
I think that was a really good definition, and to be able to provide housing to people that are at risk of homelessness or formerly homeless, to provide them permanent housing, you really do need the rental assistance, which is what a lot of these properties were paired with.
Yeah, that's excellent. Another question was just around mixed income housing projects. So these projects definitely have mixed income, as in, some are 20% units, some are, it can a range of affordable units capped at different AMIs. But are you aware of, or how have you guys done outside of this portfolio, mixed income housing, where part of it is traditional income restricted and the other is market rate or workforce housing?
Well, obviously not in the ozone fund. I think, in our portfolio, in some of our multi-investor funds, we might have some mixed income, but, a small portion that would be, at 80 to 100%. There's also, not to get onto another tangent, but there's income averaging that now allows, some units to be at 80% AMI, provided the whole project is at 60% area median income. And I think we have a couple of those, but they're a little bit trickier. You want to have somebody that's very qualified to income certify, because if a unit falls out of compliance, there's some nuances to the income averaging that you want to make sure it's a very qualified developer and a very qualified property manager.
Mm-hmm.
But I'm not aware of any mixed income projects that have used ozone.
And I would say, just to add to that, like, for most tax credit investors won't do greater than 30% market rate. It's rare to have anything greater than for market rate on a tax credit deal. It's just because it's a little bit more risk on the workforce, certainly, and the things that Model Group had done in Cincinnati definitely have a wide range, between 50 to like 90% of AMI. And we certainly see, even with the tax credit program, people being able to manage housing, which is has a wide range of incomes, or half of it's homeless housing and half of it's just 60% AMI. And we see that a lot. There's such a need for affordable housing that those units will rent up, and if you have the right manager, that certainly can be done, and that mix can be accomplished. But I under the tax credit program, investors just don't like a lot of market rate housing.
Mm-hmm. Yeah, and I'm familiar with one deal that I can point you to for Sarah, who asked the question, is the Paramore Oaks in Orlando, Florida. EIG did a profile on that project, and that includes only a portion of the units were financed with LIHTC or were eligible for financing with LIHTC, and the other ones were market rate. So I will drop a link to that project profile in the chat momentarily. So one of my questions, because I was looking at that timeline where it was basically from February 2021 to August 2021, between when the bank identified its gains, its capital gain, to when the fund closed. And in between that time, you're doing so many things, including getting, I'm just looking, your tax, accounting, and regulatory departments even on board with doing opportunity zone deals. So can you talk a little bit more about what that process was like in between when you identified the gain and internally got folks on board? Because I know those internal approvals can take a while, but it seems like everything was structured in pretty quick order.
Yeah, in retrospect, it was a bit of a crazy time, because we did, tax had basically come to us a while ago and, asking us to explore the opportunity zone program. But then, there was a little bit of, kind of digging to make sure that there was a big enough one-time capital gain to make an impact, because a lot of times these warrant gains are, kind of like a little bit here and a little bit there. And we wanted it to be, big enough to make an impact. So when we found the 110 million, and actually I will say that it was, I think by March, I think we went back and we had to look back. So it didn't really start in February. It's kind of, we had to do a look back. And then there's regulatory reporting in terms of their sort of related party, because I think part of the gain, I think the gains were, basically at the holding company, and the bank was making the investment. So we had to get buy-in from our auditors that was, acceptable. That what else? And then we just, we always want to make sure that our accounting group is okay with the fact that, we're doing a proprietary fund because of proportional amortization rules, and, so that we got their buy-in. And then just, finding the deals and, underwriting the deals and making sure that they worked, and dealing with these deals, as Kieran mentioned, have, a lot of different, levels of soft financing, and, lenders that have their own, requirements, and, closing all of those into the, the deal. These deals can take a long time to close, and, and with COVID and, it's a challenge with increasing costs and, supply chain issues. It's a challenge to do these deals. And then with the ozone layer, that just, was additional layer of complexity that we relied on NEF and their very intelligent legal counsel to, to weigh in on that. We had our own legal counsel as well, but there were a lot of lawyers involved in this.
Yeah, one of the things that I'm seeing as a trend when financial institutions, especially when it's their CRA credit that is available for these deals, when they're making opportunity zone investments, they also prefer to have some debt in the project as well. And that was the case for this portfolio of projects too, right? Correct?
Mm-hmm. Mm-hmm.
What is the advantage to the bank, to the investor, to the deal of offering both sources of financing alongside each other?
Well, I think it's a couple things for the bank. We get 2 levels of CRA credit then. And I think I think it makes it easier also for the developers to be dealing, with one investor / lender.
Mm-hmm.
It's one less party to bring to the table. Because you're already dealing with a number of, soft lenders, county, city, that are putting in money. And by soft debt, I'm assuming folks know that soft debt means no must pay payment on the debt. It basically, it just accrues, and the interest accrues over time. But I guess those are the 2 advantages I would think of, and Kieran might have something to add.
Yeah, no, I think that's, I think there's those advantages to the developer, and then right for you, Ann, it allows you to have 2 ways to bring in bank vehicles to be part of the project.
Mm-hmm.
This is the case, and we see that a lot with our proprietary investors wanting to also be able to do the construction loan.
Yeah, that makes a lot of sense. For the developers, one of the things that you guys mentioned was that, because you're front loading the equity into the deal, and you're not having to take out as much construction financing, it results in a cost savings for the developer, which can then be applied to the developer fees. So the developer is benefited in doing that. And of course, as Karen mentioned, the developer has to do some more reps and warranties, and the process may look a little bit different, but at the end of the day, there's more developer fee available. Could you imagine a scenario in which affordable housing developers are motivated to work with opportunity funds in order to access financing because they know that structure is available to them, and they may be able to get that developer fee increase? Or is it not really a motivating factor?
Well, I would say it would be a motivating factor. And I think that there's just not been a lot of twinning of tax credits and OZs for people to be that familiar with what the benefits are. So you don't hear low-income developers actually seeking it out. And maybe they would, but the other issue, of course, is that there's not a lot of banks like Silicon Valley Bank that have having large capital gains that they can use for this.
Yeah.
So, a lot of the other larger tax credit investors just, they have minor capital gains or they use them within the bank. So for those that do have them, I think there is that benefit.
Yeah. And the only reason I ask is I'm just trying to, real-time problem solve around the matching, the timing issue that you guys have mentioned around, okay, now you have the funds and then you have to find the deals. But would it make more sense if the deals were seeking out the funds as opposed to the other way around? So if the developers were the ones that were actively engaging the funds, would that potentially help in capital flow and better making those matches in time?
I guess the one challenge I would say that is that one of the benefits for the ozone funds for us has now gone away. The 10% reduction that made a big difference. And just to defer capital gains for 5 years, I don't know that it's worth the headache of trying to find the deals and put a fund together to do another one. And I hate to say that, but the 10% reduction was a big benefit for us. So I just don't know that there's going to be that kind of interest, and that there's, like Karen said, there aren't that many banks that have substantial capital gains. And this was a one-time kind of thing for us. 2021 was a banner year for our capital gains. So and to find a big one-time slug that we could use. I don't know. I don't know if the 5-year deferral is going to be incentive enough for banks with capital gains to want to explore twinning LIHTC and ozone funds. I just throw that out there.
Yeah.
I don't know.
We are right at the end. We're about 3 minutes over, but
okay.
no. I mean, it's an important, brass tacks conversation around motivations of investors, motivations of developers on the ground, to help paint a picture around the feasibility and reality of utilizing OZ financing to support affordable and workforce housing. And so what I'm hearing, just sort of in summation, is that number one, it's possible. So it's happening, and the portfolios that are being financed are high impact. I mean, this is the 4 projects you mentioned. I'm not sure if I've seen a higher impact LIHTC portfolio in the recent years. So it can be done. It's high impact, but you just have to have willing partners at the table, because there are things that need to be thought through. So with that, I'm gonna close us out and just thank you, Karen and Anne, so much for joining and sharing this great work. Catherine is back on, so I'm going to turn it back over to her for any final word.
No, that's okay. You're absolutely welcome to close it out. I just wanted to thank our guest speakers, Karen and Anne, again, and everyone for joining. As I said at the top, we will be sharing this recording and the slides and a recap of this conversation on our website and in an email to all attendees afterward as well. So thanks again, everybody.
Thanks for joining us.
Thank you, guys.
Thank you.
Okay. All right.